Sestrian Capital Research. Welcome to our weekly webinar. It's currently Thursday, the 11th of May, 5 p.m. Eastern. We have a very special session today. We are playing host to Edwin Dorsey, who runs a fantastic short stop service called the Bear Cave, published on Substack. You'll also find Edwin all over Twitter with the handle StockJabber. And I'd asked Edwin to come and talk to us all today because the discipline of short selling is not a skill that is core to us at Sestrian, but it's one that's really important to develop if you to become a rounded investment professional or successful investor or trader for that matter. Edwin does really good work. He's relatively new to the investing world, but he's going to tell you all about his background. We're going to tell you all about the service, and he's going to walk through some of his recent ideas, successful and otherwise. And as always, we'll take Q&A. So for housekeeping, we'll do our disclaimer in a moment. We always, as you know, run on a live open mic basis. And so if you have points, questions, anything along the way, just shout into the system or raise your hand. I'll moderate and handle questions. And Edwin will be flipping slides in a second. So before we start, let's just do our disclaimer. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in this webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Sestrian Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Sestrian Capital Research. Sestrian Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so I'm going to hand over to Edwin now, who's going to walk you through his background and the work he does today.
Awesome, Alex. Thanks so much for having me on. Let's see, show my screen. I think I'm sharing my screen and everyone can hear me now. I'm really thrilled to be here today and really appreciate everyone's time. I write the Bear Cave newsletter, which is a newsletter focused on exposing corporate misconduct. The Bear Cave primarily focuses on $1 to $10 billion US listed publicly traded companies that are misleading investors and harming customers. And in this webinar, I'll be going through the techniques I use to research companies, share a few examples, and be sharing a lot about what I do. So let's see here. So my focus is really can be bucketed down to two different types of companies. One, companies that are harming customers, companies that have a really bad or antagonistic relationship with their customers, or companies that I say are misleading investors or lack economic substance. Like I said, $1 to $10 billion public companies, generally off the beaten path, so it's not stuff that's heavily shorted, not stuff that's consensus and everyone's talking about. And generally, I focus on the tech or consumer space, but occasionally venture outside of that. Some examples of past companies that I've written about in the newsletter include Planet Fitness, The Joint, Root Insurance, Playtika, ZoomInfo, and I was an early critic of Signature and Silvergate Bank, which have both failed. And some of the common research techniques I use when researching companies is filing a ton of FOIA requests, and we're going to be talking a lot about the Freedom of Information Act on this webinar. I track a lot of not just executives, but also board members. I look at a lot of executive turnovers. Obviously, I look at SEC filings, read the risk factors, trying to see if things make sense. I'm addicted to the SEC full text search tool, which we'll talk about in a bit, which gives you the ability to search 20 years of SEC filings really easily. I also focus a lot more on the qualitative, the relationship a company has with its customers. So my articles in the Bear Cave almost mention no numbers. It's going to be really focused on a company's relationship with its customers. So what do I mean by companies that are harming customers? That's a kind of broad statement. What does that mean? I look at a lot of auto renewal policies to determine whether or not auto renewal policies are reasonable, fair, or are they illegal? Are companies not following their policies? One example that we're going to talk about is ZoomInfo. I spend a lot of time looking at cancellation policies for businesses. Everybody knows like gyms are like tough to cancel, but how egregious is it? Are companies following their policies? Are they operating within the bounds of the law? Is anything going to change that might make this a big issue in the future? An example of that is Planet Fitness. I spend a ton of time looking at consumer complaints, and that can be as simple as doing a Google search. But if you just Google online for complaints about a business, that can be lazy or not really a methodical way to go about it. But when you get good at this, or you spend a lot of time looking at this, you realize there's consumer complaint sites that are legitimate and consumer complaint sites which aren't that great. Some examples of the good ones are SiteJabber and Trustpilot. And then there's some bad sites that I feel can be really misleading, like Consumer Affairs, where companies can easily pay to remove bad reviews and things like that. And then the biggest thing here is FOIA is by far and away the gold standard for understanding consumer complaints and understanding a company's relationship with its customers. And we're going to talk a lot about FOIA. I look at companies that are taking advantage of the elderly. An example of that might be Playtika, which is gambling apps where people in their 70s and 80s are spending tens of thousands of dollars frivolously on their phone, just addicted to these random games. And another final example of companies harming customers is companies that are misleading unsophisticated individuals. An example like that we're going to dig into right now is Root Insurance. Root Insurance went public, I believe, in November 2020 at a multi-billion-dollar valuation. They're a car insurance company, and their claim to fame, their whole shtick was they're going to track your phone data 24/7 for a week to determine whether or not you're a good driver, based on the speeds you drive, the areas you drive, the locations you drive, the time of day you drive. And by using this data, in theory, they're going to be able to only underwrite good drivers and give you better rates. That was their pitch to Wall Street. Everybody viewed them as a really great tech-focused play. I noticed a lot of complaints and lawsuits about them online, so I decided to dig in. And the first thing I do when digging into a company like Root Insurance is I start filing FOIA requests with state regulators. Most people don't know this, but anybody, a U.S. citizen, can go to state regulators and request consumer complaints that regulator has against a company. So I think these complaints are from the Texas Attorney General, where I went to them and said, hey, can I please have all consumer complaints that mention Root Insurance in the last 6 months to try to understand what was going on with the business. And when you did that, you noticed Root Insurance, even though it was a pandemic, even though people weren't driving that much, and even though nearly all peer auto companies were lowering their rates, Root Insurance was constantly raising the rates of car insurance on people. Somebody said the rate increased 21%, even though I made no claims, have no speeding tickets, and the amount driven has plummeted due to the pandemic. Another person said they raise your rate 25 to 30% despite having a perfect rating inside the app. They say it's because of cost of repairs, weather, medical, and costs have gone up in the area. But this company is scheming citizens in the state, and you need to stop them. And hand in hand with these price increases, the company also makes it really difficult to cancel their policies. So you sign up for Root Insurance, you get a good rate for 6 months in the pandemic, and then for no reason and through no fault of your own, the company aggressively starts jacking it up every 6 months. And that directly contradicts the management statements on better underwriting and like cohort profitability improving because of better underwriting. No, it's through pricing pressure and largely taking advantage of unsophisticated individuals. Other examples include that, found through FOIA with state insurance regulators is lawyers for Spanish-speaking communities would say things like, hey, I have dozens of Spanish-speaking clients, they're all on Root Insurance and none of them can figure out how to cancel, and the rates keep going up 20, 30, 40% a year every 6 months, and we just can't figure out how to cancel them and get off Root Insurance. And lo and behold, since its IPO, Root Insurance has done terribly, down about 99% since the bear cave published on them. And this is the type of stuff where Wall Street will look at the numbers, and the numbers might say one thing and point to things going well, but when you actually dig down and see the company's relationship with its customers through FOIA by looking at consumer complaints, you can get a sense of the problems that are going to come out well before they're reflected in the numbers, or the market does. Another example I want to talk about is Planet Fitness. The bear cave wrote on Planet Fitness in January, and The big issue here with Planet Fitness is a lot of consumers have complained about difficulty canceling their gym memberships. And if you just Google, just do like 2 minutes of research, you'll find out that, consumers can't cancel over phone, they can't cancel by email, they can't cancel over the internet or in-app. Instead, in order to cancel a Planet Fitness gym membership, you have to either go to the exact gym you signed up, not any gym, but the exact gym you signed up, or mail in a cancellation form. And it's like, this sounds bad, but how serious is it? How material is it to the business? The questions I think of, like, is Planet Fitness following their policy? And is this like a 1% issue, or is this a 20% issue? FOIA is our friend. So to determine how big of a problem is, I start sending FOIA requests to state regulators for consumer complaints against Planet Fitness. Let's see what happens. From the North Dakota Attorney General, I got one complaint obtained through FOIA where the consumer wrote to a Planet Fitness location and said, I want my membership canceled immediately. I've requested this several times and I'm not playing games with this anymore. If it's not canceled, I'll be contacting the Attorney General. So even though they've tried to cancel multiple times, they can't. And even after sending this letter, Planet Fitness won't cancel their subscription. So they end up filing a complaint with the North Dakota Attorney General. Other examples here include, one person said, I've moved out of state, so I sent a letter to Planet Fitness. On December 30th, I called them and was advised they never received a letter, so I sent a new one. It's obvious they want to use mail instead of email, so they can just say they never received my letters and keep charging me. This is theft. This is ridiculous. Their employees are so rude and unhelpful. It's obvious they feel entitled to steal from me. Another consumer wrote to the Texas Attorney General, I've been trying to cancel this membership for months. I did finally make it there on the 12th, and they refused to process my cancellation because they said the next payment was still processing. They've continued to steal from me when they've been directly informed I wish to cancel, and they refuse to acknowledge my cancellation when I follow their procedures for cancellation. So over and over again, like thousands of complaints of consumers actively trying to cancel their Planet Fitness memberships, and they just can't. And normally for most businesses, if you're playing games and you have a lot of issues with customers like this, people will start disputing their credit card payments and just block payment on their credit card, and most businesses lose those. But Planet Fitness is one step ahead of consumers, and they often require people to sign up with their debit cards, which aren't even disputable. So anytime you see a business that's requiring debit cards instead of credit cards, oftentimes it's because they don't want people to have the right to dispute. Another time, a person had so much trouble canceling their Planet Fitness membership, they sent a certified letter, and even after sending a certified letter to Planet Fitness to try to cancel, the business said they can't cancel, and the business said they're refusing to cancel the Planet Fitness membership until the consumer pays their back balance that's owed. And this person's spending years just trying to cancel a Planet Fitness membership, sending certified letters, doing everything they can, and they can't get it done. And on the right here are 10 letters the Illinois Attorney General sent to Planet Fitness franchisees asking about why they're refusing to cancel memberships for people who go to the gym. And other stories that you'll read about through FOIA is people who have thousands of dollars of overdraft fees just from Planet Fitness repeatedly trying to debit their debit card accounts. Oftentimes the people getting scammed or illegally billed are the most are the elderly or poor. In the comment section of in the comment sections of articles on Planet Fitness, you'll often find bank employees talking about how Planet Fitness is the #1 source of overdrafts and consumer complaints in poorer areas. And my big takeaway from Planet Fitness back in January when the Bear Cave wrote on them is Planet Fitness a gym business, or is it an illegal billing operation with gyms on the side? And if you look kind of at the, take a step back, the top priority for the Biden administration, one of them is to combat nuisance fees and tough to cancel subscriptions. And these documents obtained through FOIA help inform my belief that, these types of issues will be hugely material to the company. And I think they just reduced guidance and had an earnings miss on their most recent earnings call.
Hey, Edwin, it's Alex. I'm going to just jump in right here. I have a question for you, which is, in our work at Session, we come at stocks in two ways, and most of our stuff is long, right? So we look at numbers and we look at charts, and we also look a little bit at reality. So if a company has a reputation for particularly good customer service, then that will play a little bit in our assessment. But we've long learned that real life isn't always related to stock prices. So if you take the Planet Fitness example, you probably could point to a lot of cable companies where it's almost as hard to cancel your cable subscription. Maybe not quite that hard, but certainly directionally like that. So how do you go from, okay, this company is just insulting its customers, impossible to deal with, really plays hardball on everything. How do you go from there to going, therefore I think the stock's going to drop? Because obviously a ton of businesses behave badly. So how do you go, this is a really good candidate for a short?
So the big thing is just determining how egregious it is.
Yeah.
If it's a small issue, if it's like all cable companies are doing this, then no one individual cable company might be like that terrible. But if you look at a lot of gyms and you see Planet Fitness is unique in being the toughest to cancel and going after people, and it's like a large material portion of the business where some people estimate like 30 to 40% of Planet Fitness members are, either actively trying to cancel, believe they have canceled, or don't want to be billed. It's like, that's a hugely material bit. 30 to 40% of your revenue, that's like way more than 100% of your profits. This is a big deal. And then I kind of like to say, you want to look at the wins of the future. Is this going to become a bigger problem in the future or a smaller problem in the future? And this is going to become a lot bigger of a problem in the future, especially for Planet Fitness, because it's becoming a thing where now with debit cards, you can even dispute transactions. And I think just that simple thing of it becoming normal for debit cards to be able to block payments, that'll be like a big hit to Planet Fitness's business. Oftentimes too, when you look at these one or two issues, you zoom out and you can form a mosaic of other things. So with Planet Fitness, I didn't talk about it, but the management team has like separate entities where they're loaning their personal funds to franchisees. There's a lot of other games being played with Planet Fitness that like kind of go beyond the scope of what I was just presenting there. So the big things are, how egregious is it? Are they following their policies? Is it in line with peers? And that can kind of inform your opinion on whether or not it'll affect the stock.
Got it. So I really like the idea that says, well, it looks like a gym, but it's really an illegal billing operation. So
yeah, with gyms on the side, precisely.
Yeah, exactly. It's like it happens to have some gyms, but that's not really what the business is.
Yeah. Another example I wanted to briefly go through here is ZoomInfo, which is a multi-billion-dollar business intelligence platform. They target a lot of businesses and give you information on, like, for your salespeople to reach out to people at other businesses. And they have a lot of complaints online about their auto renewal. And if you just read online, you'll find that you need to give 3 months notice before a renewal to cancel. And ZoomInfo is often threatening to sue small businesses that are using their products and are trying to dispute renewals. So how egregious is it? Is it in line with the competition? What's the policy? Do they follow their policy? How material is it to their business? These are the type of things I'll look at. And if you file FOIA, you get tons of complaints with small businesses to their state AGs trying to get out of ZoomInfo contracts. And one complaint against ZoomInfo is from a small business that twice asked to cancel ZoomInfo, and ZoomInfo refused. So the business wrote to the state AG saying, like, as of January 2021, it appears ZoomInfo has auto-renewed the subscription and continues to try to invoice us $1,000 a month for their services, even though in the complaint to their state attorney general, they show a clear sign that they were asking to not be set to auto-renew. In the email correspondence, you can also find that the salesperson on the very last day of 2019 was pressuring them to get the contract signed on the very last day of the year. I pay a lot of attention to that anytime companies are playing games with getting things signed on the very last day of the year or very last day of the quarter. That's a negative. But here's one example of a business really clearly trying to cancel their ZoomInfo contract and ZoomInfo just not honoring it. And the state AG wrote to ZoomInfo and said, hey, like, this person clearly canceled in your own email correspondence. Why did ZoomInfo continue to renew their policy? And ZoomInfo said that they accidentally renewed the small business due to ZoomInfo's user error. And sometimes companies will have very strong responses to state AGs and absolutely shred the complainant to parts and show they were lying. But anytime a company is admitting to their state attorney general that it's just errors on their part causing renewals, that catches my eye, because it means there's no legitimate explanation for it. And Wall Street might look at the numbers behind ZoomInfo and say, oh, look, the retention is so good, the sales number is so good, the churn is low, this deserves a huge sales multiple. But then when you dig in, you find out it's just, you know, they're refusing to honor cancellations, and most of the businesses here are really antagonized and upset. And kind of the overarching point is a business that has really happy customers that love the products, that's renewing by choice, is a much more valuable business than a business with unhappy, antagonized customers trying to get out, even if the churn and revenue and growth metrics look the same. So customer satisfaction.
This is good. You know, if you're buying, you know, my background's in leverage buyouts and venture capital a long time ago, and if you're buying a company or you're investing in a private company, you usually get the opportunity, one way or another, to, you know, speak to customers or poll customers, survey customers directly, and so you can get a bit of qualitative data behind the churn and the retention stats. Because of the public company, you can't do that. And so, yeah, this is a really good way, because yeah, of course, your retention's going to look fantastic if it's impossible to cancel. So yeah, I like this. I like the method.
It's exactly like I like to joke. It's really easy to increase a business's profits. All you need to do is raise prices and make it tough to cancel, and lo and behold, the revenue and profit numbers will look better temporarily. But I don't think it actually is building long-term value. So that's one bucket of companies that are, you know, harming their customers. And then the second bucket that I also look at is companies that are misleading investors, or I like to say lack economic substance. The term often I use is more bark than bite. And what that means is misleading investor disclosures, or if you were to spend an hour on the company's website, reading the investor presentation, reading some SEC filings, you would get a very wrong view on what the company is like actually doing. It would be very misleading to you. That's what I mean by companies that are misleading investors or lack economic substance. And what I do here to find companies like this is often I follow the people, especially board members. I like to play a little game I call board roulette, which is anytime I see a SPAC or IPO down 90% in the first 6 months, I look at all the board members and I see what other boards do they serve on. Because if your first company went to zero, I kind of want to bet against your second company. You know, oftentimes I'll look at boards, and if the entire board has little to no experience on other public companies, that's bad. If board members have ties to penny stocks, that's bad. Abrupt resignations, or like shareholder base filled with entities affiliated with pump and dump artists. And I use the SEC full text search tool to help like track that. Those are all things I'm looking for, and we're going to go through an example here. AgEagle Aerial Systems was the stock that was just rocketing in 2021, and they reached $1 billion market cap by the time the Bear Cave published on them in February 2021. And they described themselves as a pioneer in advanced commercial drone technologies. They repeatedly like hinted at a partnership with Amazon, and I decided to look into them, and kind of right away you like saw there were some issues here. If you looked on like to see what their actual product is, what's their next generation drone, on YouTube you saw their product was just a remote controlled drone with a GoPro like duct taped to it, and that's all they had. You could see that they spent $40,000 on research and development over the last 5 years. Where does the rumor of the Amazon partnership come from? It's certainly not Amazon. It's actually the chairman's daughter was making unlisted YouTube videos with the Amazon and AgEagle, you know, logos next to one another, and then people would spam like Wall Street Bets and Reddit and like penny stock boards being like, oh, I found the chairman's daughter, you know, YouTube channel, and they're making logos next to each other. This is a sign of a partnership. I just did some great due diligence. And to a retail investor, you might look at that and be like, oh yeah, I got the inside scoop. An Amazon partnership is going to be announced. Let me buy it. But you know, to anyone sophisticated here, it's like, no, this isn't how partnerships are announced. That chairman's daughters don't make YouTube videos, logos. This is silly. This is frivolous. So I wrote on them, highlighting this evidence and some more, and you know, since then the stock's fallen like 98%. Typically, you know, I don't want to write on a 50 or $100 million company that's complete nonsense, because you can go up another 2, 3, 5x. But once a company hits like that $1 billion market cap range, assuming there's like float and like volume and stuff, I think it's hard for like completely non-substantive companies to pass $1 billion market cap without there being like some substance to it. So AgEagle, like to me, a home run, and 9 times out of 10, 99 times out of 100, you're going to see something like this happen. Other examples of like companies that lack economic substance and completely collapse might be Embark Trucking, which is they made software in theory for self-driving trucks, and they went public through a SPAC and a multi-billion-dollar SPAC valuation. And I just looked into them, and the CEO was 25, and the CEO's big claim was that he made the first self-driving car in Canada. And you looked into that, and his self-driving car in Canada was a golf cart. And you look into the other executives, and all friends from the CEO's college, and you say, like, so these are a bunch of 25-year-olds that supposedly revolutionized self-driving trucking. The company had no patents, and they instead say they relied on trade secrets, even though all their competitors had hundreds and thousands of patents. And the one or two real engineers that came from Tesla to Embark Trucking all resigned in the first 6 months working there. And it's just like, okay, this company's more likely than not non-substantive, and Embark Trucking has also fallen 99% or so since its SPAC merger.
I absolutely love, right, how basic some of this stuff is. It's like, it's not actually an Amazon partnership. It's the chairman's daughter making YouTube videos. Oh, sorry, it's not really
and that's
funny.
how it's promoted.
No, it's not really funny if anyone's lost money with these things.
And stuff, but
crazy.
Everybody knows the rumors of partnerships, legitimate partnerships, don't come with the chairman's daughter making YouTube videos
No.
next to it out there. And like when you see a lot of retail participation there, it's like, okay, I get what's going on, and this isn't real. So what are some tools? How do you do this type of research? I like to use the SEC full text search tool a lot. So everybody knows what Edgar is. Not everybody knows that SEC full text search tool is a separate website that lets you search all SEC filings in the last like 24 years for any phrase, any name, any address. So I can put in a board member's name and see all companies they've been affiliated with, where their name is listed in any SEC filing. So not just where they've been on the board, but where they've been an executive, where they've been a shareholder. You can put in an address in and say, has this corporate address been used in any other SEC filings, maybe for past penny stock stamps. You can put in a specific lawyer's name into SEC full text search tool and be like, where else has this lawyer appeared in SEC filings? And are his past clients all like jokes or frauds or nonsense companies? I like to use the PCAOB auditor search tool. We're going to talk about this in just a second. This is like a public website where not only can you see who a company's auditor is, you can actually see the specific audit partner responsible for auditing a company. Again, a free website that's great to use. We talked about FOIA. TGIS, I absolutely love. It's pretty expensive, but it's a tool that lets you get access to like an open database of expert network calls and read a bunch of transcripts. I'm a big fan of Bedrock AI. I think this is one that's pretty cheap, but it lets you type in any company's name, and it gives you not just like an AI risk score for the company, you know, it highlights the specific like, you know, language from SEC filings it views as high risk. So this is an early stage way for me to get a sense of some problems. I'm absolutely addicted to Insider Score. I love you. The first thing I do is type in a company on Insider Score, see who the board is, and within minutes to see where all the other board members have worked in the past. Obviously, I'm a big fan of Twitter, YouTube, Reddit, Glassdoor, Blind, which is a tech-focused like Glassdoor. And people say Seeking Alpha is terrible. I kind of agree some of the time, but I think the comments section of Seeking Alpha articles and other sites can actually be really valuable. Often, if you sift through enough stuff, you're going to find one or two really smart people lurking in the. There's a saying: to get the right answer on the internet, say something wrong, and someone will correct you in the comments. And I feel like that's true with Seeking Alpha some of the time.
I'll jump in there. We publish very successfully on Seeking Alpha. We have a top decile service on there, and so at least one of the authors on there is pretty good. I will say this about Seeking Alpha, which is something I find interesting. If you publish, which we do, on well followed stocks, right? A big contrary indicator I've found is that if you are bearish at all on fanboy names, Tesla as was, not so much now, but as it was, Apple right now, if you put out a negative note on Apple, a ton of rocks just lands on you from a great height, with people coming up with, I'm going to say people in inverted commas, they're not real people, all kinds of spurious reasons why things that appear to be bad are in fact good. And it's a fantastic contrary signal, actually. It's not necessarily one that will deliver you a short win tomorrow or next week, but when you've got an army of either promoters or frankly, negative commentators. You know, you can spot the organized armies a mile off when you know what to look for. You see a whole bunch of negative stuff all over Twitter sometimes about, you know, the high growth stocks when they're at their stock lows, and lo and behold, wait a month or 6 weeks and the stocks are up. So these sort of organized online mobs, for me, is a great contraindicator, both for long and short positions. And so you can learn to spot them, and your Seeking Alpha comments point is well made. You can often find them in there. Enphase Energy, you know, another one. You dare say something bad about that, you get a wall of people telling you why, you know, declining gross margins are in fact a good thing.
Absolutely, Alex. And the really last thing to say here is I love the PCAOB auditor search tool so much. I just wanted to give an example where if you look up EHang Holdings on the PCAOB site, which is just linked here, you'll find that the specific auditor for the company is Ernst & Young, China, but the specific audit partner is Li Yang. And if you just look on the PCAOB website, Li Yang, before being the audit engagement partner for EHang Holdings, was the audit engagement partner for Luckin Coffee, which had fraud issues, and was the audit engagement partner for China Cache International, which collapsed and went to zero. And it's like, if your first company audit goes to zero, if your second company you audit has fraud allegations, and the third company audit, EHang, faces a short seller report over fraud allegations, it's like, I'm more likely than not, I want to bet against EHang, and EHang later went on to fall like 90% or so. I also track executives that we've talked about. I talked about how I like to find companies that have collapsed, track all the board members, and see what other boards they serve on. I look at all, for the newsletter, the Bear Cave, I look at all the executive resignations, roughly 100 disclosed every week, and try to find the 5 or 6 that really stand out. So people leaving after just less than a year, or a pattern of resignation. So if an audit committee member, CFO, and chief accounting officer all leave in a 6-month period, that's not good. Things that make no sense. It's just a little more than just looking at like the current main executives' histories. And with that, you know, that's what I do. And I'd be happy to answer any and all questions. The Bear Cave is, you can find by just Googling the Bear Cave newsletter, or go to thebearcave.substack.com. And I'm really active on Twitter under my name, Edwin Dorsey, and the handle's @StockJabber. Alex, I'd really love to answer any questions that the Cestrian Capital audience has. And I'm a big fan of your newsletter and service. So you guys do great work as well.
It's very kind of you to say so. Have at it, folks. I've got a ton of questions personally, but it'd be great to hear from anyone else on here. I'm also, Edwin, just keeping an eye on our private chat room here in one of our services where we've got a couple of questions coming through right now, so I'm going to read those out as they come through. But anyone on the call here that has questions for Edwin, either about specific stocks or method or anything else really, anyone can use the audio here. So I've unmuted everybody our side. And just open up your mic and shout into the system if you have a question. So Edwin, we have one in our private chat room, which is a simple question from Jay, who says, how do you track what works? Was his question.
How do you track what works?
Yeah, by which I think he means you have, you know, a range of methods here, and I'm assuming, so Jay's a professor of data science, so this will be a statistics question, which is to say, you know, how do you work out your hit rate per method? I would assume is what Jay's question is. So he clarifies that. He says, amongst all of your methods, how do you track performance by method?
That's interesting. I don't think I've literally broken down, hey, like, it's tough to quantify very specifically. It's a little more like going with the gut feeling when you're looking at certain things. I would say what I'm strongest with is FOIA, because I do this a ton, do it more than probably anyone else in the country. I have a sense, you know, whether something is egregious or not, but it's tough to like quantify, like, oh, this company has this many pages of complaints, that's bad. Well, you don't know, and some of the complaints are frivolous, and the company's responses carry like a lot of weight with me. So it's tough to, you know, quantify any of this. Likewise, with the board members, you know, if you see any public company board where none of the board members have public company experience, that's egregious. That's, you know, almost always going to be a failure. But oftentimes it's like a little more mixed, where one or two board members have served on big companies. A board member might have a tie to a penny stock, and then half the board has no public company experience. And it's like, how do you like quantify the like failure rate there? I would say you can only use it as a piece of a mosaic, as part of a broader story. So you wouldn't ever want to just look at one of these methods in isolation. You need to see like big issues in all these things, with the board, with the executives, with consumer complaints, with maybe a little promotion, in order to like have a successful thesis.
Okay, makes sense. Any other questions, folks? Okay, I have a question, which is, Jay says thanks. So thanks, Edward.
Yeah.
I have a question, which is, how do you stand apart from, so my experience of the short selling world, okay, is that there are broadly two camps, right? You have your grenade throwers. So I won't name any names, but we've all read their work, which is just, garbage. It's wrong. And I've seen a couple of folks publish short reports on the company, some of the companies that we cover, and I've known for a fact that the report is just garbage. They've said that, there's no cash flow, and I know for a fact there is, simple wrong stuff. And these are guys who will take a large short position, either via the equity or short-dated options, publish and promote a short report, stock dumps, they cover, and then either just bank the money on the cover, or they'll then go long and ride the recovery. That's Group A. And then you've got Group B, who operate on, I would say, something of a moral police basis, and I'd put you in this camp. So between you, Mark Cahodas, Parrot Capital, all these guys, there's much more of sort of an indignant view that says these companies shouldn't be screwing around. I'm going to publish on this. Now, you don't take short positions in the stocks that you write about. Is that right?
Yeah, so I don't short or buy puts on any of the companies I write about. I only make money from paid reader subscriptions to the newsletter.
And what's behind that decision? Because there's obviously there's as long as you disclose these things, there's nothing wrong with doing both. So why do you run that way?
Well, I would say a few things. You say there's nothing wrong with disclosing you have a short position on a stock and publishing negative research. And I kind of agree, but that's not actually like what happens. And as you alluded to it, first you start by shorting, and then you start by, well, if I'm going to short and move a stock, maybe I should buy puts and move the stock. And if you say, well, if I'm going to buy puts and move the stock, I'm buying a ton of puts can be like set off alarms. So maybe I buy calls and puts, and I buy the calls in a worthless way just to reduce my cost of buying the puts and like lower suspicions. And then it's like, well, if you're going to do that and you're running on a big company, you could also short the stock, and you might not have a huge capital, but why not partner with the balance sheet partner overseas who's going to, take a huge short position in the stock and rebate to you a percentage of the profits. And you go deeper into this, and then it's like, let's want to do deep work. I'm very document based. I basically am just Googling, filing FOIA requests, reading filings. Some people might go farther than talk to current employees or talk to recent former employees or hire private investigators. And I think it slowly kind of morphs from, I'm like, just highlighting public info and short the stock, to something like maybe a lot more questionable. And there's not like, to me, a lot of stuff falls into a potential gray area, and rules are kind of ambiguous into what's allowed and what's not.
Right.
So a good way to avoid all this and keep your hands squeaky clean is just, hey, I'm not, trading or betting against these stocks whatsoever. I'm just doing research from my computer, reading filings, filing FOIA requests, just genuinely trying to understand the company and what the market might be missing, and twice a month writing articles on companies that I feel are misleading investors or harming customers. Yeah. There's a purity to that. I think it's an honest way to make a living. I think it's very, very sustainable. To the extent that you'd ever get something small wrong, it's like, I think companies would be I think your legal defense is a lot stronger if you're like, hey, I'm just a 25-year-old with a popular newsletter, a popular blog, than, oh yeah, I'm just like taking huge short positions in small stuff. And your incentives change. When it's to move markets, your incentives change where of course you're going to want to be a little more flamboyant or maybe have price targets that are a little too low or call something a fraud. But when you're just doing this for readers, there's no incentive to be flamboyant and exaggerate. You can be purely intellectually honest. And I think that's what gives me like some credibility in the newsletter. Credibility is I'm never saying something to try to move a stock. I'm just giving you my opinion based on the evidence and quoting from filings and showing what I found just digging around in the public domain.
So no shady overseas balance sheet partner then?
No, not at all.
Oh, okay, that's a great answer. I will say, for anyone that's not familiar with Bear Cave newsletter, the growth of that thing has been fantastic, and I think in part that's because it's a pure play. It's a pure play, publishing business, and I think people respond to that purity, if you like. So it's one of the most successful publications on Substack. And as far as I know, Edwin, it just keeps on growing. You've done incredibly well with it, and it's very well thought of and very popular. It comes in free and paid versions. We'll circulate links and so forth later on after this, but no, you've done really, really well with it. A couple of comments coming in.
Alex.
Yeah, I see it. The comment from Nick, who says brilliant and deserved success, which I'd agree with. Anyone else have any questions, folks, on for Edwin on any of the topics we've raised so far, or anything to do with shorting generally? Because this isn't an area that we spend very much time on in our services. At Zestream, we write some short stuff. We tend to do it for free on our Substacks, just out of interest. It's a lot more fun than long, frankly. But any questions at all? I've got a couple coming through on our chat room, Edwin, so I'm going to read them out when they pop.
Okay, and I'll just tell anyone there's no stupid questions, and I love talking about.
That's what I always say. That's what I always say.
Please ask away, guys.
Yeah, in my experience, people like to hang back because people are always worried about feeling stupid, and there is no such thing as a stupid question. The best questions are the most simple, most childlike questions. They are always the best ones. Okay, here we go. Also from Jay, who says, have you ever considered integrating financial data such as declining cash flowing or margins?
So it's not like kind of, but not really. It's just my strong suit. What I'm uniquely strong at is this qualitative stuff. I think I'm really, really good at that. There's tons of smart analysts on Wall Street who understand the numbers and modeling and that sort of thing. So I just don't think I'd like be adding a lot to the dialogue if I start saying like, here's my view of the cash flows and like up and down. There's a lot of like stuff like that. Unless I'm going to do it to an excellent degree, might as well not do it at all. I really like focusing on just the qualitative because that's what I'm strongest with, and that's what there's like no competition for.
That makes sense. I mean, one thing that's certainly true in your line of business, in publishing any sort of stocks newsletter, is strangely the narrower you go, the more successful you can be, because you just pick one thing, as you say, that you excel at, and just keep doing it over and over and over and over. And these niches are, to borrow somebody else's phrase, an inch wide and a mile deep. And if you just become excellent at one thing, there's always a big audience for that. So I understand.
Yeah, I totally agree.
I have a question from Christian on the chat room who says, have you ever seen a business show up on your radar, but work themselves back into good territory with corrective behavior?
So they look bad, but then they end up being great?
Yeah, you give them a telling off and they become good people in the end.
Well, yeah, whether a person's bad or good can be a little complicated. One example that comes to mind is the very first company I wrote on was Celsius Holdings. They're they make the energy drink Celsius, and they had a ton of red flags, especially with the prior management team and a lot of accounting games and acquiring distributors and such. But the thing that mattered for them is that people liked the Celsius energy drink. The drink was popular and they were great at marketing it, and energy drinks have huge margins. And that stock went up 5 or 6x, maybe 4x since I published on them back in like 2020. So that was the one, my first article was kind of the one big failure where I bite myself a little for like messing that up. It's not really like, oh, someone has a history of acting unethically and they become really great, upstanding citizens. I think it's more sometimes a company under like past leadership might have had a lot of issues, and then the leadership changes and people don't people are skeptical of the new leadership, but the new leadership can install like a new set of morals and values to the organization. I think that happens sometimes. I can't think of an example where it's like, oh, this guy has been like a pump and dump artist for 10 years and then suddenly became a great executive.
Yeah, there's a comment here from Nick, one of our members, who has a career in corporate turnaround, so would be flown in by investors to go and fix a let's call it a challenging situation. Who, in response to my comment about do any of these bad people become good people, just posted no.
Yeah, that's fair. No, sometimes it's a no, but sometimes when management's changed, the company will be still valued like a dirty company, even though it might have clean management. And sometimes companies with like a host of issues might just, magically, like Celsius, grow out of them.
Right. I have a question from a different Nick, which is, he says, "I'm sorry if you mentioned this earlier. I've only just been able to log on. Do you look at your overall success rate, e.g., for a year after publication? How often do the shares trade significantly lower?" So he's not asking for, is it 3%, 10%? Yeah, nothing, not like that. But ballpark, if you write up 10 companies, roughly how many of those will be materially lower a year later, would you say?
So I really don't view it ever as the article being a short recommendation. I never say to short. I never include price targets. I barely talk about numbers. What I do is very, very different than almost like any other finance newsletters. At the end of every year, though, I do look back and see like what percent of the companies are lower or higher. And generally, it's something like 80% are lower.
That's pretty good.
But I'm really proud of like how many companies end up falling 90% or more. So like I was really early on criticizing Silvergate Bank and Signature Bank, and those went to zero. And the joint fell 20% on the day I released my article, and I think 85% in total. Root Insurance is down 99%, Trade Terrace is down 99%, Greenbox is down 95%, Curiosity Stream is down 90%. And now, the one big failure, as I mentioned, was Celsius, which went up. And I think there was maybe one other company that doubled from the date the Bear Cave published on them. But it's not solely stock price related things. And sometimes I'm just writing on a situation that I find interesting. Like it could be a de-SPAC that there's no borrow, and you can't even short it. It's just something I find interesting.
Yeah.
So
I would say I don't know much about Celsius, but I do know that trying to short any cult type stocks is a nightmare because they don't trade on anything to do with reality most of the time.
Yeah.
I've got a question coming in from Andrew, who's on the audio. I'm going to unmute you, Andrew.
Hi, Andrew.
Hang on. Hey, Andrew, can you unmute yourself your side? Okay, while he's figuring that out, we've got a written one in from Sylvia, which is a question is, did you ever look at a company called Sorrento Therapeutics?
I've heard a lot about them. I never really dug in because just healthcare is a lot tougher for me. Healthcare and like banks would be two things that kind of can go over my head a little. So I don't really write on healthcare names, but I have heard of them.
Okay, very wise. So you said earlier you tend to stick to consumer and tech, did you say?
Yeah, because those are the most understandable. That's where FOIA is going to be the most relevant. FOIA for like healthcare, it's like what people are going to send complaints about their drugs to their attorney general. Like you might be like playing games with the FDA or something, but that's not where FOIA really excels. That requires deep domain expertise. While I think I can look at any $1 to $5 billion tech or consumer company and just after like 10 minutes get a spidey sense on whether something is deeply wrong or not. I couldn't do that with a healthcare company. If I were, it would be to say, look, all these executives have a huge track record of failure, huge track record of litigation, and like there's a organization that is formed by like a former penny stock artist affiliated with it. It couldn't be to opine on like the drug's efficacy.
Yeah, makes sense. Maybe we've got a few minutes left. Maybe we could talk about one stock that I know you've been writing about, we've been writing about as well, which is Coinbase, ticker COIN. Do you want to talk about that one a little bit now?
Yeah, let me see. Just give me 1 second here. Yeah, so like
By the way,
Coinbase.
so sorry to interrupt. For disclosure, I am personally short Coinbase. Okay, through
Very fair,
simple.
Alex. And for disclosure, I obviously have no position because I've written on them, but I'm extremely, extremely bearish. And this is kind of a consensus Wall Street short view. It's just this is a company that's losing a ton of money. I think they're going to continue to lose a ton of money because they've got a ton of headwinds. They're generally, one of the higher priced firms to trade cryptocurrency. If you look, 2 years ago, Coinbase was the only game in town, so they did wonderfully. But now there's tons of competition. And one thing that makes Coinbase structurally disadvantaged is Coinbase only offers crypto trading, while a lot of other platforms like Robinhood, Webull, SoFi, whatever, offer crypto trading, but also loans and margin and equity trading and other financial products. So these other firms can use crypto almost as a loss leader to fund their other types of business and get accounts.
Right.
So it's like Coinbase is at a huge disadvantage there where they can only do crypto. They have like unsustainably high fees. Their trading volume's going down. Most people don't know this, but they get a large amount of their like high margin interest income from a stable coin called USDC that's like just declining month over month in circulation. So that reduces their interest income. Plus, I think the management is extremely weak. They have a ton of litigation issues coming up, and they've antagonized the SEC in a really real way. And I'm just stunned by the way they interact with the SEC, where I'm pretty sure Brian Armstrong was threatening them a little, saying, you don't want to litigate against us because we're a well-resourced adversary. And it just came across as like a high schooler trying to threaten their teacher rather than, this is an executive of a $10 billion company.
Yeah.
I am, if there's one company I could be short right now, it would be Coinbase. I would bet dollars to donuts this does not go well for them over the next year.
We just put a note out on Coinbase today. It's a free note on our Tech Select Substack, so anybody can read it. And I mean, I wrote that up myself. I don't go into the same level of depth that you do on the short stuff, but I have to say it's quite a lot more fun than anything long, because wherever you go looking with these things, you can find slimy things under rocks. And the difficulty that I have, because I like detail, is to avoid just going down every single rabbit hole you find. So if you were to, you could spend a week on the Coinbase 10Q and find all the questionable items in there, I think. The company's got some problems for sure. So if you're interested in Coinbase, anyone here, take a look either at Edwin's work online, take a look at our Tech Select Substack. There's a note we published about an hour ago on that, and take a look again. For disclosure, I am personally short Coinbase. I just have a simple short equity position. Question coming in from Jay, which is Airbnb. Now, you published a short note on Airbnb about a month ago. First of all, kudos to you because it moved the stock, and that's a big stock, so that's pretty impressive. Mm-hmm. I personally don't agree with you on it. I think that it probably does do all the bad things you said it does. I suspect the stock's going to keep going up anyway because I think it has quasi-monopoly characteristics. So we're probably not going to agree on the stock. However, I thought it was a really impressive piece of work insofar as it moved the stock, and that's not easy to do, not with a big liquid name like that. So do you want to talk about Airbnb a little bit? And for disclosure, I'm long Airbnb personally.
Fair enough, Alex. And
well, one of us will be right.
Sorry?
I said one of us will be right. Who knows?
But one of us will be right. We'll see. But I don't. So Airbnb is kind of an anomaly. I typically stay under $10 billion market caps and focus on the really egregious stuff. Airbnb obviously has a real business and is a valuable company. The question is this, is this a $80 billion company, a $200 billion company, or a $20 billion company? And my view on Airbnb is that the market just thinks about it the wrong way, where the market views it as like a royalty on exploration, the one and only platform bringing together millions of disjointed listings and like the only place to go if you're looking for like Airbnb type, rentals. When the reality is, what's been happening is it's not just like mom and pops putting places on Airbnbs. In my view, it's becoming a lot of professional management groups that have 5, 10, or 100 properties in a local market, advertising their properties on Airbnb, promoting them. And the issue there becomes, well, then the power dynamics change. If you're dealing with like millions of individuals, that's really valuable. If you're dealing with 10 or 20 professional management groups in any market, those professional management groups have more of the power. And what these management groups have been doing is they often create the identical listings offline for 10% cheaper. So management groups are aggressively trying to shift it so you find something on Airbnb, but then you book on their own website, save 10%, and then most importantly, the management group controls the relationship. They get the cash up front, they get to deal with any customer dispute issues, and they can market to you again in the future. So my logic behind Airbnb not being a great thing was I'm their target demographic. I'm 25, I'm earning a good amount of money, I like to travel occasionally. I was hosting a birthday party in Nashville with 14 friends, and I needed to use Airbnb to find a good group rental. And I look at these nice places in Nashville, and I found one that was great. And then I look up like the management group that was advertising on Airbnb, and I saw they had their own site where you could book it for 10% cheaper. So I book it just directly on their site. And of course, you'd prefer to book directly with them because it's better for them. It's like booking with the hotel directly rather than through an Expedia-like service. So I booked directly through them and had a great time, saved money, didn't give Airbnb a penny. And then they start sending me coupons to book with them again in the future on their site. And I'm like, this is stuff that, to an investor would all be done on Airbnb, but it turns out that everybody's trying to shift off it, because if you're building a big property management business, you don't want all to be dependent on Airbnb's algorithm and dispute resolution. So all these big hosts are like simultaneously trying to cut Airbnb out. And my view is Airbnb is going to be kind of like an Expedia-like service, where now it's when you go to any one market to find a place to stay. If you're an individual, you want to do hotels. If you're doing group travel, you might want Airbnb, but you use Airbnb to find the 5 or 6 players in the market for group rentals. And you might book directly on Airbnb, or you might book directly on their site. But it's not that Airbnb's future is going to be a lot different than its past. In this time of like Airbnb being a platform for individual hosts, I think that's gone. Individuals.
So I was going to sum up. You would say basically that it used to be the Death Star in the middle of a buy side and a sell side network that were comprised of small individual atoms. So an individual host on the supply side and an individual guest on the demand side. And what you're saying is that on the supply side, those atoms are coalescing into larger bodies, which are going to basically disrupt the gravitational pull of Airbnb. In other words, its monopoly power is going to be undermined, and therefore its margins are going to drop. That's your basic thesis.
That's a fair way of putting it, Alex. Yeah. Yes.
Yeah, I mean that might be. I mean, Morgan Stanley put out a $95 price target this week, I think, after earnings. So yeah, I can see the logic. So yeah, we'll see with that one. But kudos to you just on the report, because it was a well written report. Again, I particularly agree with it, but it was a well written report. It was well distributed, and it moved the stock, and that's not easy. So credit to your skills there, Edwin.
Thank you, Alex. I really appreciate it.
You need an evil offshore balance sheet partner.
No need for them. Absolutely not. I just need more readers. More readers is always good.
Well, look, we're pretty much out of time. If anyone's got any final questions, let's have them. Otherwise, what we'll do is, okay, we've got a couple of nice comments coming in. So, great discussion. Thanks for showing up. So I would second that, Edwin. It's a great pleasure to speak to you. I really like your work, and it's great to hear. I mean, to be honest, if you have anything approaching an 8 out of 10 success rate, I mean, frankly, 5.1 out of 10 success rate is all you need in this business. So if you have anything like that level of success, that's fantastic news. What we'll do is we'll post the recording of this once it's compiled. We'll put it up on YouTube. We'll post links to Edwin's Substack and his Twitter service. And I'd certainly recommend everyone takes a look at the Substack. I personally subscribe to the Substack. I pay for it, for the paid version. I think it's really good value, great work. We do not, for clarity, have any kind of affiliate relationship. We don't profit from anybody that signs up to Edwin's service, but I always like to promote people who do great work and do different work, and do work from the perspective of the investor, not the perspective of the issuer. In other words, do buy-side work, not sell-side work. And Edwin's a great example of that. Okay, well, look, we're right on time, so let's wrap up. Edwin, just thanks ever so much for showing up. Great presentation. Thanks for taking all the questions. And hopefully we'll see you again soon, and wish you the very best of luck.
Absolutely, Alex. This was a blast. The Sestrine Capital community is wonderful. Thank you so much.
And thanks everyone for showing up today. And of course, thanks for reading our work, whichever of our services you subscribe to. I appreciate all the time and effort and the money that you spend with us, and what plan to keep on doing a great job for you. Thanks a lot, everyone. Speak to you soon.